really excited to be here again this year. Great crowd, and thanks to Luann and team for putting on a great conference. We have a great panel today. Really excited for those folks that may have been at a conference last week. Some of us were on a similar panel and had a very interesting discussion. We're going to talk about securitizations in the space. Before I do that, and I'll let each one of our panelists introduce themselves, the format's going to be a little bit different than you're used to. Our goal today is to talk about securitizations in the space. There is a tremendous amount of activity on ongoing securitizations. I'm proud to congratulate John on a deal that's closing right now, a second securitization in the space that we've been involved in. Thank you.
Thank you.
John's group have been the pioneers in securitizing the first securitization of lending club loans, and so it's really exciting. And then my friends from Can Capital are not here today, but they have a $200 million transaction that priced yesterday and closes tomorrow. Small business merchant cash advance type of transaction that we worked on with them as well. So the first question I have for the panel, and I'm going to start with John, is basically his view from the state of the industry in regards from an investor point of view. John, what are you seeing out there today?
Sure. I think I would say that we're seeing tremendous innovation across the space. When I started Eaglewood Capital 3 years ago, you largely had retail investors funding retail borrowers through a handful of platforms, and there were small number of investment structures that actually allowed access to these to this asset class. I think we're seeing tremendous evolution and innovation of investment structures across the space. We closed our first securitization of lending club loans last year, and in the past year we've seen, I'm not sure what the count is at this point, but I would say half a dozen to a dozen securitizations of similar assets. OnDeck obviously closed the first merchant cash securitization a few months ago, so we've seen a lot of innovation. And I expect that to continue, including to some foreign markets where we're seeing some interesting developments.
Well, great. And so, Lou, I'll turn it over to you at this point. Maybe you can share with the group a little bit about your securitization, which was the first merchant cash advance small business transaction in the space.
Yeah, I mean, so we completed our first rated securitization May of this year, and it's a very, very interesting process. Obviously, going through the rating agency process, first time on a new asset class that we created, never been to the market before, so it was a new issuer as well. I think, from a company's perspective, I think it really improved our cost of fund and the capital structure significantly. And I think also, given the rating agency's involvement, I think, essentially we provided a lot of data to the rating agency and got them comfortable that OnDeck as a servicer originator and, validated our history and our credit model. And I think I'll also echo what John has said, which is, when we sort of went on the market roadshow, the transaction was extremely well received, and the deal ended up to be very well oversubscribed, and we ended up with almost 20 investors in the transaction. And I think that's great news for the online lending space in general, because I think if you look at sort of the traditional securitization market, the traditional assets are still being securitized, credit cards, autos, but sort of post financial crisis, if you would, there are very few new asset classes actually getting securitized in the space, and I think investors are looking for new ways to deploy the capital, and I think investors are realizing that aside from just your traditional specialty finance company that's actually originating assets, there's this new alternative lending space that's online platform that's generating assets in a very innovative way and creating a product that has a lot of credit merits to it. And that's sort of how we felt, through the roadshow process, where, large insurance companies that did a lot of work and, ended up being allocated, $10 million worth of bonds. They really, I think it's a vote of confidence, if you would, to the space in general, and and they really believe, I think a lot of investors actually believe this is a sector here to stay and here to grow, and they like to sort of, participate in the growth with a lot of the companies and, OnDeck, especially in that space.
That's a great point. So Paul, you folks have done a securitization yourself. Private student loans is an asset that's been securitized quite a bit, but your model is a little bit different on online. Can you share with the group a little bit about your securitization?
Yeah, I think SoFi has a bit of a different problem. So there are plenty of folks introducing new asset classes. Private student loans have been securitized by folks like Sallie Mae, First Marblehead, but have a pretty terrible reputation as far as defaults go. We took a very different credit approach, delivered it in a cost-effective way and a consumer-friendly way. And I think when we went through the process, in our first securitization in December was a $151 million deal rated by DBRS. Second deal in July was a S&P DBRS rated transaction for $250 million. And I think one of the really critical things that came out of the S&P process is SoFi ended up with the lowest base case default rate ever assigned by S&P for an unsecured consumer asset, which I think took a lot of work in getting the S&P folks to understand what we were doing, but also I can tell with Gary here, they have a phenomenal team. We probably went through 400 or 500 different questions about how the assets work, how this works, how do we find data that supports what you're saying. Like, we all get it conceptually. Refinancing people who've graduated from school makes sense, but being able to demonstrate that to an agency where they can go back to their committees and basically say, yes, what you guys are doing, whether it's a new asset class or whether it's a different take on an asset class, it's work, and you have to either have the historical data, and folks like OnDeck who've been in business for 7 years, they've got the benefit of internal data. We have a bit of a shorter life cycle, so we have to rely on public data, and I think that approach has been pretty successful to date, and it's a continuing dialogue that we're having with the folks at S&P and DBRS and the other agencies that we're working with.
Well, and so now all roads lead to Gary, right? So Gary, as you're getting involved in many of these new assets, whether we call it peer-to-peer or marketplace or online lending, what is some of the methodology that S&P is looking at in regards to the rating process?
I think you phrased it in the right way, in the sense that it's a new asset class, and irregardless if it's consumer loan, small business, student loan, et cetera, what we're looking at is new entrants into the space and a marriage of fin and tech. Other people had mentioned that earlier. And you have to be bringing that equally to the table. You can't be heavily technology-based and not bring the financial acumen that you need for credit risk. Can't be vice versa as well. It's a very new space in that sense. One of the things Paul mentioned is our attraction to data. A lot of what we had asked for, they actually provided data that we traditionally hadn't received for other student loan types of securitizations in the past. So they brought a depth to their data set that actually assisted in the analyses in a very positive way. One of the things that we're looking at from data, though, is that even with the longer established players in the market for marketplace lending, is they haven't gone through a cycle, an economic cycle. So even through that time frame that they exist, they may have adjusted their credit underwriting, adjusted their model. We have to be able to understand what transpired over that time frame, and then go the extra step of trying to figure out what kind of stress should we apply to this particular asset class. We do leverage our data and knowledge of other unsecured consumer lending and other secured consumer lending in our space, but you still have that level of uncertainty. One of the assumptions with, and one of the panelists had mentioned, is servicing. We, from a rating agency's perspective, if the party is not rated as high as whatever it may eventually be for the debt issuance, we assume they go away the day after the deal closes. So how am I going to service this portfolio of loans and continue my cash flow stream to the debt holders? Who's in place? Have they tested those systems? Is there a gap of when that backup servicer comes on board? Is it a liquidity risk that you have to somehow address in the structure? So taking all of this information, what we try to do first is a feasibility of a new entrant coming in. We look at the management, the history, their backgrounds, the technology that they employ, the servicing, other data sets that they may be able to have in terms of their own experience. And we go through to sort of say and give guidance to the rating committee to give them some view saying, well, maybe AAA is not appropriate for right now. It's too early in the space for this, and SoFi came out with a single A on their transaction. So they experienced this in the sense that, you know, you have to walk before you run. And there's a lot of new entrants coming into the space, so we have to understand, you know, what are their goals as an organization. So that guidance is given to the rating committee, and it could say that, okay, it's not AAA, but maybe it's somewhere lower than that. But even if you have a structure which has some risk to it, the rating you could eventually get for a rated transaction could be even lower than what the guidance is provided. So it's a very interactive process with the parties and the other players that are involved in the structure.
Great. And so, as I mentioned earlier, we'll change the format. So I'd like to open it up to the group for a question or two in regards to the first two topics, what we're talking about in regards to the rating agency process and the investor view at this point. Any questions? Yes. Well, we have a microphone for you.
Do you all have any favorite or new ways of evaluating risk? In other words, besides FICO, or when we went to the LendIt conference last time, I was very impressed that a lot of the lenders online said they weren't even using traditional metrics, and they were actually getting much superior returns, and I was fascinated by that. So could you give us examples if you're using those, and if so, which ones are they?
So typically you may find that in lower credit, right, where you're doing non-traditional credit bureaus. Typically they're buying and originating more of a higher credit, but I'm assuming you're asking about companies like a Factor Trust or a Clarity, non-traditional credit bureaus. Is that you're looking at?
I guess from my background is that the traditional methods of underwriting, whether it's a real estate deal, having been in both markets as far as independent investors and also mutual or actually hedge funds and syndications, what I found was that there's actually a superior ability for a lot of the smaller people that are in the business. They actually are far superior, sorry, but they are for the people who are in the local markets, especially in real estate. You can write it if you're local in LA or San Diego or Phoenix. You can know that market better than the person in New York no matter what, because it is a local issue. And it doesn't need to be. And we were the largest syndicate or largest owner in Texas. So we actually were able to vet deals and underwrite them, but it was because of our market knowledge. It wasn't because we used data.
Gotcha. So the panel is not involved in real estate, but maybe it's pertinent to John. John, you guys are buying loans from different platforms, and is there some, without giving out your secret sauce, some underwriting parameters that you use?
Just to be clear, we're an asset management firm. We do not have our own underwriting or origination platform. But what we've done in the peer-to-peer space is created our own algorithms and tools for re-underwriting loans that the platforms create and underwrite. And generally speaking, we will receive on each loan around 80 separate data points related to the borrower and the borrower's credit report, et cetera. We have automated the process by creating our own internal software, downloading that data. So you're talking several thousand loans a week now. We can download that 80 data points on each loan, run it through our software and our own credit model, and submit purchase instructions back to the platform telling them which loans we want to buy. So we have, over the last 3 years, developed our own effectively re-underwriting system and some very high-speed ways of and highly automated means of executing those purchase instructions.
So, OnDeck as an originator in the small business space, we actually found FICO not being that useful for small business loans. And as a matter of fact, I think that's part of the reason why banks are so inefficient in lending to small businesses, right? So if you think about, Joe, who has a regular job, W-2, making $75,000 a year, versus Joe, the pizza shop owner that has $1 million pizza shop business attached to it, right? They tend to have a much more volatile FICO score because they carry personal debt for business use, right? So they're more volatile. So FICO is not a good indication. the alternative bank look at is they ask for tax returns, which also is not a good indicator because small businesses tend to break even for some reason at the end. So what we have found is FICO actually lags the credit history of the small business. So what we do is we actually pull, for any given business application, we actually pull something like 2,000 to 5,000 data, whether it's your credit bureau, whether it's your bank information, whether it's your credit card processing information, social media, a lot of proprietary data that we have developed. So if you look, we basically compile all those data and create this concept of OnDeck score, and then we make loans based on OnDeck score. If you look at our securitization, actually there's no FICO component or eligibility criteria at all. It's run by an OnDeck score. So our portfolio composition has to be constructed in that way. So I think there's just so much more useful information out there. We actually find FICO actually lags OnDeck score by roughly 6 months. Which is kind of interesting. Think about just at a high level. If you're a small business owner, your business goes into trouble or some sort of stress, OnDeck score will go down, and it eventually impacts your personal life, and it sort of lags that process.
Right. So alternative, Paul, your business is a little bit different because you're driven by FICO, correct?
No, FICO is really actually not part of how we do our underwriting. Okay. So I think if you look at SoFi, we've taken a very corporate-oriented approach to underwriting. So the example you gave of making real estate loans in Texas, and it's the same in any big city, right? Manhattan, all neighborhoods are not created equal, and understanding that granularity requires a degree of expertise that then becomes difficult to scale. So what we've done at SoFi is tried to look at effectively what a consumer's ability to pay a loan is, and then what the volatility of their income is, right? So you take a really simple example of a lawyer and a nurse, right? A lawyer is going to have a higher income to start with and probably a higher income trajectory, but it's also much more volatile, right? A nurse is probably going to have a much lower income, but an extraordinarily stable income. And so when we look at those two profiles, how do you manage the tightness at which you're willing to underwrite that credit? And I think we've incorporated those kinds of metrics around forward income projections and effectively what your net after-tax available cash is into how we underwrite. Now, we're definitely constrained by FICO, and not to speak for S&P, but I have a feeling, and not just S&P, but other investors, if we put out a pool of consumer credit with a 620 FICO, it just would not be well received. We can sit there and explain 6 ways from Sunday why we're so much smarter and why our way is 10 times better. We will get terrible execution. So for us, we definitely have a pretty high FICO, and it's definitely a disqualifier for folks who have not behaved positively in their credit history, but it ends up not being a huge constraint for us. The biggest constraint, and the reason we reject people primarily, is they just can't meet that income free cash flow requirement.
Great. So, Gary, where does FICO and some of the other credit characteristics play in the rating game?
Well, I think we've seen an evolution from historic FICO-based only to today where FICO is a component but not the driver of particular lending, and it could be across the gamut of consumer asset classes. Each lender, be it someone on this panel or even in the auto space, if you wanted to pull them up, they're looking for other attributes. They're coming up with other drivers or characteristics which add a fuller picture to that particular borrower. Someone who's coming out of bankruptcy versus someone who's in the low subprime to the non-prime to the prime. They're all looking at different attributes that drive and contribute to the performance of that consumer's history. So what we need to do is just understand where the particular originator is focusing their attention, what drives their credit model, and what changes have they done from their original data set to today and where they want to go with it.
Great. One more question on this topic? Yes, sir.
I'm just interested to know what the types of investors that have been involved in these securitizations so far are. What kind of buyers are they? I know that Western Asset Management Company, for example, was a big buyer in SoFi's last deal. What aspirations do you have for the types of people that you're attracting? And have you found that the lack of focus on FICO, for example, and traditional credit metrics like that has discouraged those kind of big institutional buyers that you're trying to attract?
So, I think there are market constraints when you talk about types of money. Folks who are traditionally kind of asset manager, money managers, aren't going to buy long duration fixed paper. That's an insurance product. So part of it is driven by the type of assets that we originate. So for example, our last transaction was 50% fixed, 50% floating. We had about 30 different investors in the transaction. It was about 14 times oversubscribed. But the mix is really, mostly asset managers on the floating side and mostly insurance companies on the fixed side. When you start talking about what our aspirations are, I think one of the things we're starting to see as investors are scrambling to get both product and yield, they're taking a much more aggressive approach in basically talking directly with SoFi and getting much more involved prior to the transaction. So historically, the way this works is we build up a pool of assets that we hold on warehouse lines. We go to Morgan Stanley. They securitize the assets. They have a syndicate desk that talks to investors, and the whole deal gets done. What we're starting to see now, and we saw it in our last transaction, we're now seeing it go forward, is investors coming to us and saying, look, we want to commit $50 million of capital towards your loans, and then we want to access the leverage you get through your securitizations, basically to give us a residual yield. And it's just driven by the fact that there's not a lot of product out there, and everybody's looking for pretty much anything that has over a 2 to 3% yield. And certainly when you start talking hedge funds, folks who are looking for residuals that are going to yield 6 to 9 spreads over LIBOR, there's just not a lot of that out there. So it's extremely competitive, and investors are starting to get that, and that means they're coming to issuers, and they're trying to get in front of the traditional syndicate process. Great.
So I want to move on to another topic because I think it's important that we talk about this. We're seeing a lot of international type of appetite, whether it's the UK or Canada, Australia. We've recently done a few transactions there. And John, recently you sold a good portion of your business to a large UK firm, and you guys are growing in the UK. Could you share with us about the opportunities you see overseas today?
Sure, absolutely. So earlier this year, we raised a permanent pool of capital through a publicly traded UK investment trust that has a mandate to invest in peer-to-peer firms globally. So far, we've primarily invested in the US and in Europe with that vehicle. So I'll speak primarily to the European market. I would say that the European market is 2 to 3 years behind the US in terms of its institutionalization. But we're starting to see the emergence of whole loan programs, particularly in the UK. This summer, we saw 3 UK platforms launch whole loan programs for the first time. We're starting to see higher quality servicing and purchase agreements being put in place, and we're seeing the platforms put better operational and legal structures in place that will ultimately accommodate leverage and securitizations. Interestingly, a few of the platforms in Europe actually have longer track records than Lending Club and Prosper. And so from a rating agency standpoint, I think that will actually be very attractive. You can go back 8 to 10 years and look at the performance of these assets, and there are a handful of platforms that have had absolutely exceptional performance in Europe. They've been incredibly conservative. The downside is that the yields are much lower. But we are seeing the foundation of an institutional market being created in Europe today.
And so, Gary, is there a difference in ratings, and does S&P participate in the international markets for ratings of these assets?
Well, having been a international emerging markets analyst for most of my career at S&P, I would say yes. We probably are, in terms of interaction, a little bit more lively here in the U.S., but it doesn't preclude one of the other countries, be it the UK, Australia, Canada, to come up with a securitization. We'd look at it similarly as we would here in the States, notwithstanding any legal or regulatory issues that are specific to the country, and then see how that drives where the outcome is in terms of a rating. So the answer is yes.
Great. So let me, while we're on this international topic, open it back up to the audience to see if there's any questions from the group here that they have on on the international markets while we're here. Yes.
Just with regard to the UK, and I wonder if you could kind of draw a parallel with the US here. I think that one of the most important distinctions between what's gone on in the UK and what's gone on in the US is the level of support from a regulator level and the level of support from a government level, where you've actually literally seen the the UK government place money with platforms such as Funding Circle, shout to Zopa, and Zopa, as you alluded to before, has actually got a much longer history than even the leading names here in the US, and in fact originated the model. I'm just wondering if you can make a sort of regulator to regulator comparison point for the UK to the US.
Sure. You know, I'm probably not best qualified to answer that question. I'm not an attorney. We have, as I mentioned, we're starting to see better institutionalization of the UK platforms. To your point, they are regulated by the UK government, and the UK government is an investor on those platforms, unlike here in the United States. And that regulation has, from what we can tell, really bolstered confidence in the sector and removed a lot of the uncertainty that otherwise hangs over the sector as we all await certainty over what the regulators will do. So primary difference I see in the UK versus the US today is certainty. The regulators are there. They're favorably disposed towards the sector. And so far that's been very positive for the sector.
And thanks. So let's just move to some final thoughts here. We're seeing a lot of activity in the space. We're seeing, Lending Club and Prosper, SoFi, OnDeck, and others with record volumes every month. We're seeing new platforms coming out every single day. I get the calls for them for servicing or backup servicing. You guys get the calls in regards to investing. Gary gets the calls in regards to possible securitization down the road. Final thoughts on outlook and risks in the space? I'll start with you, Gary.
Just like any asset class, once you get your hands around it and can understand the risks and concerns that are inherent in either the business model or in terms of the actual performance from the origination, you can address any type of credit risk in the end. Right now, we're in a spot where we're learning, we're educating ourselves, understanding more of the dynamics. Going through processes similar to what we've gone with SoFi and understanding their business model and the differences. That was my world in the past, of going into a country, understanding what the issues are, what the particular asset is, and what are the concerns that have to be addressed from a rating agency's perspective. So I think eventually you will see a platform-based lending securitization. I can't give any timeframes for that. But I think it's going in the path of being cautious, making sure that all the T's are crossed and the I's are dotted, because there's going to be a lot of eyes looking at it, and that's the benchmark for the future ones that may come down the marketplace.
Right. My friend Ron Suber calls it EAU, right? And Ron's talks have many of the conferences around education, awareness, and understanding of the space, and so we're seeing that throughout. Paul, final thoughts?
Sure. So on the kind of growth and development of the SoFi platform, I mean, I think for us, it's really just continuing to work with the agencies to move from a single A rating to a AAA, AA, single A structure, which is 18 to 24 months of work. We're going to start doing mortgages. That's SoFi's next big initiative. I think we're going to start seeing mortgages outpace student loans next year. And that's going to be a whole new conversation with the agencies. It's a much more structured universe on the mortgage side than is in student loans. If we hand them a pool of assets, they're going to run it through a very traditional mortgage model that S&P has called levels. And there's going to have to be a conversation between the folks who have gotten to know us on the consumer side and the folks who don't know us on the mortgage side to figure out how we reconcile what SoFi's doing with what a traditional 90% mortgage would be. I mean, I think our outlook on the business is extremely positive. I think folks understand what we're doing. It's just about continuing to get data and information, both from our own history and from other sources, that help back it up, both with investors and agencies.
Great. Lou, final thoughts?
Yeah, I mean, we're very bullish on the sector, and I think, you know, from OnDeck's perspective, you know, we've been around for 7 years, and you know, our origination has been going very well, and I think part of our focus is how to serve small business population better. You know, they have different financing needs. We have a lot of new product in the incubation stage. You know, we're trying to diversify our investor base through securitization, through bank lines, and through marketplace where people can purchase whole loans. I would echo with Gary's concern about just the market in general. I mean, if you look at the space, obviously there's a lot of equity VC interest in this in the fintech space. You know, we're very focused on credit. We're very focused on how to grow responsibly to maintain the credit quality of our portfolio. The thing we sort of joke about internally was, you know, lending club, the lending institution as a platform. You know, if you sort of measure revenue growth by how much money you give away, which is kind of a foreign concept because all of us can just set up a shop to give away money. It feels like you need to measure by how much money you actually collect back. So I think, you know, that's sort of a roundabout way to say, like, you know, we're very focused on credit. You know, we're very focused on top line growth as much as, you know, bottom line growth, and we're trying to diversify our funding platform and you know, improve our cost of funds. So, you know, ultimately our customer, which there are the small businesses, will get the benefit of better product and better pricing.
Great. And John, final outlooks from an asset management and an investor point of view?
Sure. No surprise, we're also bullish on the space. But we think the online lending sector is poised for significant growth over the next decade. When you look at the platforms that SoFi and OnDeck, Lending Club, and others have created, they are extremely efficient at underwriting and servicing loans, particularly small balance loans, that the bricks and mortar banking system traditionally has ignored. And I think that these platforms are incredibly scalable. They do not need, unlike their traditional banking counterparts, they do not need to grow physical infrastructure and headcount in order to grow their volumes. So we see these platforms scaling significantly over the next decade and presenting us with a variety of investment opportunities, both on the equity side as well as the debt side. In terms of risk, I think the originate to distribute risk is something that every investor in this space has to come to terms with. I think there are a lot of structures and protections that an investor can and should put in place to protect against those risks. But I think that will be a topic in investment circles for the next few years.
Well, great. So thank you, everybody, for attending. Thank you to panelists here.
Thanks.